Welcome to Stock Talk with Nico Kritikos. Today we're going to be going through the ultimate dividend portfolio, and I'm going to be showing you which stocks I think are the best to hold in a dividend portfolio and why. And I own the majority of these, and a couple of these I don't own yet, but I'm plan on owning. So the first one on the list is going to be Walgreens. And before I get into this, I want to say the main things that I look for when building this out is one, a high dividend, okay, but not only a high dividend, but a healthy dividend, meaning consistent growth and consistent payouts year after year, as well as a low payout ratio, meaning the company is paying a low percentage of their earnings as dividends. Okay. The next thing is I want so consistency. I want I put beta on here because I want the beta to be low because I don't want the stock to be too volatile. If the stock pays a 10% dividend, but it's up and down 50 and 60% every year, well, that doesn't help me much because I'm losing so much money on the share price. So I want a low beta, preferably under 1, because a 1 beta means it's correlated with the just like an average index, like the stock market. So below 1 means it's going to be less volatile. Above 1, if it's a 2 or something, that means it's going to be twice as volatile as the market. So then the example I used here was, let's say you had $10,000 and you invested $10,000 into 10 different companies equally. So $1,000 into 10 different stocks. And I think that's very attainable for anybody to do. Then based off of this portfolio, you would get $600 a year off of dividends. So that's not counting, share appreciation. And then the yield is going to be 6%. And your average payout ratio is going to be 70.7%. I did not count AT&T because their payout ratio is like an outlier, and their operating income is healthy enough to where it's higher than what they're paying. It's like $21 billion of operating income and $15 billion paid out in dividends. And AT&T is such a monster company that one is a little bit of a different scenario. So that 1,600% payout ratio doesn't look good, but it's a little bit of an exception. So anyways, let's get into this. So stock number 1, we're going to put $1,000 into Walgreens stock. Now, I bought Walgreens back when it was about $45, $46 a share. And now it's went up a little bit since then. I think it's at $54 a share, but it's still I personally, I would not buy it at this price. I would wait till it's around 50 or below, but still, Walgreens is still a steady, a trustworthy company, not a volatile company. The beta is only a 0.6. So like when I bought it, the dividend yield was actually above 4. I think it was like a 4.1, 4.2%. Now it's a 3.5% because the stock price went up. So the yearly dividend income would be $35, payout ratio of 27%. That's very low. I think that's the best one on here. And so Walgreens could easily double their dividend. If they wanted to, they could pay a 7% dividend and it would only be half of their earnings. But I think everyone knows what Walgreens is, just pharmacy retailer. Next up, we have Arbor Realty Trust. This one does not get as much attention as it deserves. This is a REIT, okay? And I made a separate video on this a couple of weeks ago, but ABR is just, I think they specialize in multifamily properties. And they have most of their properties like in New York, Florida, Georgia, Arkansas, Illinois. And yeah, they have a very healthy balance sheet valuation, a PE of only 7.7. So yeah, Arbor Realty Trust, I own lots of shares of Walgreens and Arbor Realty Trust. I want to say over 100 of both stocks. But Arbor Realty Trust has a beta. This is the highest beta on here. That's the only thing about this one. It is a smaller company. It's only like a $2 billion company. So the beta is high, but the stock price has just been like this for years because their revenue and net income just keep going up. 7.5% dividend, and that's a 56% payout ratio, pretty healthy. Next up, we have Verizon. This is one I just bought a week ago. Beta of 0.4, super low, so you don't have to worry about this one moving too much. And then you have a dividend yield of 4.7%. That's not bad at all. So the average stock in the S&P 500 will give a 2% dividend yield. So if you can get above a 2%, you're getting above average. I personally I want something above a 4 and 4, 5, 6%. That's more what I'm looking for. But 4.7% for Verizon, and this one's kind of weird. Look at all the numbers are the same. 4. They're all 4s, 47. So 47% payout ratio for Verizon. That one's healthy. PFF, this is a, if we look here, this is an index fund. It's made up of bonds, and so it has, so 50% of it is BBB bonds. It has bonds, and then it has some utility stocks in there too. See, so yeah, Next Era Energy, stuff like that. But this one is, if you look at the stock chart, this one is not, this is like the least volatile one on here. So yeah, well, it has a 0.8, but if you look at the chart, you can see it doesn't really move. It pretty much stays right around $37. But this is just an index fund, and it pays, I think this is a monthly paying one too. The rest of these are all quarterly dividends, I believe. But PFF 4% dividend, and payout ratio is, since it's a fund, it doesn't really have one. And then we have enterprise products. I just made a video on this a couple days ago. EPD beta of 1.3, a yield of 7.6%, very high, and then 100% payout ratio. Not great, but if you compare it to all the other companies in their industry right now, I just did a video on this. They're like all around, they're all like over 100%. So that's actually, that's normal in their industry right now. But EPD is a, they do gas line pipeline stuff. And so they're one of the biggest in the world. I think they have, the market cap's like $50 billion. So that one is a good one too. Next up, we have Amcor. I've owned this one for about a year now. And Amcor is one of the world's leaders in packaging. They make packaging for food products, for medical products, all these different things. Beta of 0.4, super low, yield of 3.8%, and a payout ratio of 77%. So I love Amcor. That one is, I'm a big believer in that one. Next up, B&G Foods. B&G Foods is like almost like a holding company, because they own like, 30 plus food brands. They're in a bunch of grocery stores with they sell products pretty much in every single thing, in spices, in kitchen supplies, in plates, all these different things. So yeah, that's a good one there. This one I really love because the beta is so low. Dividend yield of 5.7%. I remember when I bought in this, I used to think this was a high. 150% is a high payout ratio. That's not good. That's like the highest one on here, really. But the thing with them is I don't know, I felt really safe buying into them, because they were acquiring new brands, and I mean they sell like, they have a big ownership in all the products in the grocery stores that you see at Target and Walmart and Meijer. So that one, I'm not too worried about that one. They own a bunch of the food brands, so it's like it's almost like owning like a Procter and Gamble or something. It's not very, I don't see that one as a risky bet. So I think, I think the income and the revenue will just, it'll grow with time as sales go up. Next up, MPLX. This is similar to enterprise products. They do a lot of the same thing. I think this one, they also deal with water pipelines, but this one is a very high beta, one of the highest betas on here. So you got to watch out for that. But a yield of 9%, that's really what you, in this scenario, the stocks that have a high beta that are more volatile are also going to normally have higher yields. So that's why you got to have a balance of lower dividend, but safer, less volatile, and then other stocks that have high yields, but are of course going to be riskier and more volatile. So that's where we get, just to up the dividend yield average in this, we want to get those higher ones, and the beta will balance out with the lower beta stocks. And that one is 100% payout ratio, just like the other the natural gas line pipeline one. Then we have British American Tobacco. This one I do not own, and I don't know. This one I've thought about. It looks great. The beta is low. It's not a very risky stock, and the yield is 6%. That's great, and the payout ratio is 79%. Everything looks pretty healthy. Everything looks great with this one. I don't know. I don't really want to own a tobacco company. I don't know. I'm not a big believer in that. I don't see a big future for tobacco companies. So that's the only thing with that one. Same thing with Philip Morris. It's the same thing. It's a pretty similar story with that one. Good dividend yields, and they have big sales and stuff, but I don't really want to own a tobacco company. Then finally we have AT&T. This one has always had a problem with their balance sheet. It's not a good balance sheet. They have tons of billions and billions of dollars of debt. That's why I don't own this one either. But it has a low beta, super high dividend yield of 7.7%, and it's AT&T. I mean, the chances that this one goes under is extremely low. But yeah, that payout ratio does not look too healthy at 1,600%. If you look at AT&T's balance sheet right here, I've actually thought about buying this one recently though, because the stock price has come down so much. It's like half of what it was a couple of years ago. So it's kind of a compelling story here. But as you can see here, equity has been coming down the last couple of years. And then we go to cash flow. It's not as bad as it looks. Operating cash flow trailing 12 months, $40 billion. And then they, end cash position is now at 21 billion. That's really good. But we go over here, you can see that cash paid to dividends is 15 billion. Then they received 21. So let's see if we go to quarterly. Yeah, so even when you go back, it's still, so I guess let's see how much. I don't know. I guess that's just something to look out for, is that payout ratio. Hopefully it comes down. But sometimes big companies like that are so dominant in the industry, sometimes they can get away with it. But yeah, so altogether, this is what you get: $10,000 split evenly between these stocks. You average 6%, 6% dividend yield, which is $600 a year, and average a 70% payout ratio. That's not too bad. And then a beta of 0.9 is under 1, so it's not going to move too much. And these are a lot of these are super, safe companies that have been around for 100 years and they're not going anywhere. I mean, Walgreens, Verizon, AT&T, the tobacco companies, these companies are probably here to stay. So yeah, this is the ultimate dividend portfolio you can own. Thank you much for watching, and I will see you in the next video.